Welcome to Powerhouse, where we interview the biggest names in housing and ask them about their strategy for growth. I'm Diego Sanchez, president of HousingWire, and my guest today is a special one. It's David Finkelstein, CEO of Annaly Capital Management. David, it's so great to have you on the show.
Well, thank you, Diego. It's a pleasure to be here today on Powerhouse.
David, the first question is a simple one. What is Annaly Capital Management?
So Annaly is a mortgage real estate investment trust. We're the largest of the mortgage REITs. We have $15 billion in permanent capital allocated exclusively to housing finance. Our portfolio is roughly $100 billion in assets, which consists of $87 billion in agency MBS, $7 billion in resi credit, and $3.5 billion in mortgage servicing rights. Now, agency MBS has historically been the mothership of the platform, and our evolution into resi credit and MSR actually began in 2016. Primarily through the acquisition of a firm called Hatteras Financial, which is another mortgage REIT. And with that acquisition came our Onslow Bay platform, which a lot of folks in the market know the OBX shelf, and also Pingora Loan Servicing, and the MSR portfolio accumulated by Pingora. Now, more specifically with respect to MSR, at that time, we very much liked the MSR asset and even launched a joint venture with Sovereign Wealth Fund to grow our MSR holdings. But we ultimately decided to sell the servicer entity to Bayview, but continued to acquire MSR through our JV. Now, in 2020, coincident with my elevation to CEO, we wanted to expand our footprint in MSR, but do it on our balance sheet directly. And thus we initiated the operational build out of our MSR platform, with purchases beginning in 2021. And this really accelerated in 2022 as rates began to increase and the originator community sought the liquidity of a large capital partner like Annaly. And where we sit today is that all three housing finance businesses are fully scaled and have been for the past few years, and returns have been strong. We've generated an average annual return of approximately 13% over the past 3 years as of the end of the third quarter. So we're very happy with our progress, Diego.
And what are your continued ambitions with respect to MSRs? Are you going to keep building a book, or how does that look for you?
Well, look, Diego, from a big picture standpoint, Annaly is an industry leader with respect to managing interest rate and prepayment risk. And we're the only scaled MSR investor who began as an agency MBS investor with a focus on specified pools. And the time-tested analytics we utilize to evaluate loan-level characteristics in MBS are the same tools used in MSR. So there's considerable synergies with the agency portfolio, not to mention the natural hedge of just interest rate risk management. And all of our rate and convexity risk is managed by one team, which is a powerful differentiator. And MSR enables us to further deploy our market risk management infrastructure. Now, there's many scaled industry participants who have created competitive advantages through efficient management of origination and servicing operations. And we've found that partnerships with these entities create alpha for both parties. And as technology and the use of big data evolves, we're highly encouraged by the value servicing customers can have for a servicer. So beyond cross-sell and second liens, this can include insurance, other forms of borrowing, and even wealth management. Now, as far as portfolio size, we've been very public about targeting 20% of capital with one full turn of leverage for our MSR holdings. Currently, we hold roughly $230 billion in unpaid principal balance in MSR, or about $3.5 billion in market value, as I said. So at 20% with a turn of leverage, we can grow to roughly $400 billion in UPB, or about $6 billion in market value. Now, a key to our scale, however, is that we can own a very large portfolio of MSR without the MSR owning us, given the fact that it's 20% of capital and it doesn't dominate the overall portfolio activity. So we feel like that's about the appropriate scale for us.
So room to grow, but also MSR valuations are pretty high right now. Do you continue to acquire with MSRs as high in terms of valuation as they've been this year?
Look, MSR multiples have expanded, to your point, but we don't see MSR valuations as being materially higher than they were at the start of the year. So fundamentally, prepayment speeds are relatively low. The yield curve is steeper and volatility has declined. Also, low delinquency rates in conventional loans lower the servicing burden associated with owning MSR. And servicing costs are declining as AI and new technologies are rapidly adopted. And increased comfort in relying on recapture and cross-sell revenues also enable us to justify additional purchases of MSR. And so I understand that multiples have expanded, but the fundamentals of MSR still look very reasonable to us on a prospective basis.
All right. You mentioned partnerships as your way to service these MSRs that you're acquiring and the book that you're building. And about a year ago, you entered a subservicing partnership with Rocket. How is that partnership going?
Precisely as planned, both with respect to our borrowers and the management of our MSR asset. Now, as it relates to borrowers, they're getting the best customer service experience possible, as we've observed. And as it relates to the asset, we're able to obtain industry-leading recapture on our MSR. And also to note, we're quite enthusiastic about the Rocket Cooper combination, as Mr. Cooper was an existing subservicer of ours. And we can now have the best of both companies applied to our portfolios, which are serviced there.
Now, interesting combination with Rocket and Cooper, consolidating some of your subservicing into one partnership. But just last month, you entered a similar subservicing partnership with PennyMac. Is this a little bit of you spreading your eggs across several baskets?
Well, diversification was certainly a motivator and a benefit, but not the driving force behind the initiative. So PennyMac is a very experienced and successful operation with differentiated servicing and recapture technology that we're candidly quite excited to have access to. And that was the motivation.
And do you think you'll enter more subservicing partnerships as you grow this MSR portfolio? It sounds like you have some dry powder to keep growing your book.
Well, we do have additional subservicing partners beyond what we just discussed. And an important point to note is that the recapture partner doesn't have to be the subservicing partner. For example, we have subservicing relationships where we plug an independent recapture partner into that relationship and kind of get the best recapture with high quality servicing as well. So we're pretty adaptable to what the market offers in terms of the ability to acquire subservicing and recapture, and we're going to be very nimble about it. And we do dedicate substantial time and resources to exploring partnerships and business development, which will continue as pricing competition persists. And a broad subservicing network gives us a great lens into the latest technologies and strategies. And also, the process is useful for evaluating existing partners and assessing the benefits and trade-offs of potentially bringing various operational capabilities in-house.
So most of the big servicers, we've talked about Rocket, combining with Cooper. There's several other servicers that are building very sizable books of MSRs. Almost all of them are investing in technology and deploying technology to originate from their book. How do you think about recapture with respect to your subservicing partnership strategy?
Sure. Well, recapture and expectations for cross-sell in the future have become a material component of MSR valuations. And it's critical that if we're going to participate in the MSR market at current valuations, that we extract these cash flows. And through partnerships with industry leaders, we're able to accomplish this without incurring execution risk, fixed costs, or significant operating leverage. So it's critical, Diego. Mm-hmm.
Yeah, that makes sense. So let's talk about mortgage rates and housing market data. Mortgage rates have been really locked in a range of 6.2% to 7.2% this year. Do you see rates breaking out of this range anytime soon?
Well, there's considerable uncertainty around the rates landscape, which is why we are currently hedging the vast majority of our rate exposure in this environment, Diego. Now, specifically with respect to your question, we are at the lower end of that range in mortgage rates you cited. And as far as breaking out, it's not our view at all that we'll retrace back through 7% in this cycle at all. But I would characterize the range to be somewhat symmetrical around the low sixes in mortgage rate. Obviously, the Fed is cutting, but expectations are well priced into the forward curve, and intermediate to longer term rates are not priced to decline much further from here, if at all. And thus, the probability of the mortgage rate going materially lower from here is somewhat low in the absence of a negative shock to employment and economic growth. But it's also difficult to see a strong catalyst for back to north of 7% mortgage rates. And so I think we're in a new range here, and we probably will break through 6% at some point, but there is some probability of climbing modestly higher. And we're in the unfortunate circumstance of a shutdown where we don't have a lot of data, but nonetheless, there is enough information out there to give us some level or some sense of the rates market, and we use every tool we can find.
Yeah, I mean, it sounds like you're saying sort of 5.5 to 5.75 up to 6.5 is kind of the range that you're betting on.
Mm-hmm. That's about where I would characterize the range to be.
In light of your view on this range of mortgage rates and the overall picture for the housing market, will Annaly's investment strategy change in 2026?
Well, it's market dependent, obviously, but we have said publicly that our intention is to grow our resi and MSR portfolios to a combined 50% of capital, 30% resi and the 20% levered MSR I referenced earlier. So that is a longer term objective, but we'll be very patient in that pursuit. And if the market doesn't offer it over the near term, our current strategy of modestly overweight agency MBS is perfectly sufficient for this investment climate, which has been characterized by declining volatility and robust demand for fixed income, driven partially by the Fed's cutting cycle.
You have a really interesting background that includes time at the Federal Reserve Bank of New York. How do you think the Fed is doing navigating their dual mandate in this really tricky economy?
Sure. So the Fed has a very difficult task, given that we're on the wrong side of both of their mandates, inflation and employment. We've seen inflation forecasts accelerate largely in light of tariffs and somewhat stubborn services inflation ex shelter. And also the labor market is clearly weakening. Oh, and by the way, the shutdown complicates the picture further for obvious reasons. You have some FOMC members that are more concerned about inflation and others more worried about the employment picture. It's almost evenly split, in fact. Now, policy rates remain restrictive, and so the desirable direction is lower rates. But like Chair Powell said in the last press conference, when there's fog on the road, you have to proceed slower and with more caution. And that's what we expect going forward, which is perfectly appropriate. So to answer your question, Diego, monetary policy is a very tough business right now. I know many of these policymakers, and they're very quick to acknowledge the challenges in this environment. And overall, I think they're doing an admirable job, particularly in light of the politics of the day.
David, I really enjoyed learning more about Annaly Capital Management today. Thank you so much for joining me on Powerhouse.
Well, thank you, Diego. It's been a pleasure to be here with you on Powerhouse, and I'll look forward to seeing you soon.